Teresa Matic with the Investing News Network. Here with me today is Gwen Preston, publisher of the Resource Maven Newsletter. Gwen, thank you for joining me today.
Thanks for having me.
So Resource Maven is fairly new. You launched it late last year. Why now and why in this market?
That's a good question, and really it comes to sort of the premise of what I'm doing. I've been in this industry for 8 years, mostly as a journalist, and from that scenario, I experienced a lot, I learned a lot. It was an incredible learning opportunity, but I was a little bit constrained in what I could do from an investing perspective. But then fast forward to last summer, I looked around and this is the bottom. I saw incredible opportunity around me, and I had the chance, probably like you, to interview from and learn from the best in the business, and a lot of those guys made their money and made a lot of it by investing at the bottom. That's the entire contrarian investing model, right? And so that's why, is because I saw incredible opportunity and I wanted to be a more active participant in that opportunity. And if I was going to spend my time researching and figuring out what I was buying and selling, and what I like to do is write about and educate others in general about mining because I'm passionate about it, it made sense to launch a newsletter so that we could all hopefully benefit from the opportunity together.
Okay, and we're coming up on about halfway through the year now. Have there been any big surprises from the gold space so far?
Yes, no. Gold is a surprising metal all the time. I don't think there have been any big surprises. Certainly, gold and metals in general is a pretty seasonal market. So we always see, the beginning few months of the year we get a run, and then the summer doldrums are very reliable. We almost always get a setback in the summer doldrums, even in bull markets. And then usually the fall is a bit better. So I guess one surprise would be that the first few months of the year, that run was very short. It was sharp, but it was short. So that was a little bit more setback than I expected, but as long as you have a strategy for managing risk, it doesn't matter. You just have to be aware of what might be, pay attention to it, and then see what actually happens and make moves accordingly.
Okay, and speaking of your risk management strategy, your strategy at Resource Maven involves locking in gains once the stock reaches a certain point, even if there could be further upside. So I'm wondering, how has that gone over with your subscribers? Have you seen any pushback because of that?
No, if anything, in this market and in the context of this 4 years of, to be blunt, terrible resource markets, I'm actually getting a lot of positive feedback about that strategy. I think one of the problems in this sector is that we all fall in love with the sector, and it's the nature of the beast, right? There's these really exciting discovery stories. We fall in love with the stories. Everyone's out there telling you these really interesting tales. So it's easy to fall in love, but buying is only half of the equation. Arguably, the more important half is selling. And I don't say that you should get in, get out completely. What I say is do your research, figure out what the best stocks are, buy them, and then because this is such a roller coaster of a sector, even the best stocks, the market darlings in a particular year, will have a crazy share price chart. Lock in some gains once you've reached some level of upside, and then retain some portion of your holding. I usually say sell between a quarter and half, depending on the situation. So then you still have upside because you're still in, and most of the stocks that I've recommended selling, I still hold, like I say, at least half, if not more, of my position. But my cost base is less because I sold some when I was up.
Right, that's interesting. Can you speak to more what you mean about the cost base being less?
Sure, let's give you an example. So because of seasonality, because the mining markets are so seasonal and so usually reliable in that, I recommended buying several stocks in mid-November and late December based on the fact that I saw upside in gold in the short term. So one of those was Iron Gold. So we bought at $2.39 in mid-November. I expected gold to run for longer than it did, but it turns out that it fell quite sharply in late January, so it was a short run, but that's okay because by the time, by halfway through January, we were up 45% in IM Gold, so I said sell half. I still believed in the story, I still believed in the upside, but why not pick up some of the money that's been put down, lock in some of those gains? So we took our cost base from $2.39 to $1.33. Granted, the size of the holding is less, but the cost base is really down. We're at $1.33. IAMGOLD hasn't traded below $1.50 in a decade. So the risk of losing money is greatly minimized, and the opportunity to multiply your money is increased. So it's just sort of the nature of me. I'm not a super risky person. I like to manage that risk, and it's a really active part of the Maven model. And I've actually been getting some pretty good feedback, especially from subscribers on that.
Okay, that's a pretty compelling argument, but now I'm wondering as well how that goes over with people featured in your portfolio, like IAMGOLD and other companies.
Sure, for sure. And yes, that is the other side of the question, is that nobody likes it when you say sell. But given the context of the market, and given the fact that I maintain active relationships with the companies in my portfolio, in general, they understand. They realize that lowering cost base is what they would like to do with their upside, right? And so I've been, certainly they don't love it, but the companies generally don't hate it. They understand it, and they realize that I haven't, for most of these, I haven't, like, in the context of this model, of this strategy, I'm not talking about getting out. I'm talking about retaining your exposure and increasing your upside. So I continue to follow the stocks. I continue to write about what their news means and why it matters and why I like the stock. So it's a pretty balanced approach, and they understand in the context of this sideways market, you really need to manage risk.
Okay, that's good to hear. And then as well, you gave quite an interesting presentation where you mentioned a lot of the metrics that you look at when you're evaluating these companies. You have quite a long list, so can you go over some of the most important metrics that you look at?
Sure. I'd say it's a really common question that I get. So what is the one characteristic that's most important when you're evaluating stocks? And there is no one. When you're looking at explorers, developers, and producers, it's a long list. And we're looking forward, in the long term, especially in the medium term, to a metals rally. And there's a potential for very significant wealth generation in the next few years from this broad-based metals rally that I truly believe is going to happen, and lots of people in the sector share that belief, including some very successful, proven investors. But you still want to position very sensibly, very proactively. So you need to look for the cream of the crop. And in that, when you're looking at sort of the exploration and developer side of the market, you need them to have good jurisdiction. You need the asset to check off a bunch of requirements. It needs to be in the right place. It needs to have the right metallurgy. Metallurgy is very important and one that often gets overlooked. The deposit needs to have the right combination of grade or size, depending on what it is that you're trying to do. The management team needs to be very active, very networked, very experienced and proven. The technical team needs to be strong. The company needs to have a plan for what it is they're trying to do. They can't just keep drilling or whatever it is. They need to have a plan for how they're going to create shareholder value. Not just how they're going to make the deposit bigger, but how they're going to create shareholder value. It's really important. They need to have cash or access to cash, because if they don't, they're going to dilute their share structure dramatically. So that's another one. They need to have a sensible share structure going on. They need to have, if you're closer to the development end of things, you need to have a capex for your project that makes sense. So there's a long list. You go all the way to the producer end, the list changes a little bit and it focuses more on what their costs are, what their production profile looks like. Have they strangled that production profile in an attempt to rein in their costs? Do they pay a dividend? That matters a lot, because we spend a lot of time talking about speculative, high-risk, high-reward stocks in this sector. But in this bear market, we all have an opportunity to position in some of the big boys who produce a lot of ounces, who have a lot of leverage to the upside that I see in gold, and who will pay you to hold their stock. So I think that there's a lot of opportunity to position, to create a broad portfolio, but every entry in that portfolio needs to answer a lot of questions.
That's a lot of information.
Absolutely.
Okay. Well, thank you. It's impressive you remember all that. One final question for you, Gwen. What is the last stock you bought and why?
All right, the last stock I bought and why. So just last week, I put out a newsletter that actually had 3 recommendations in it. One of them was B2 Gold. So I talk a lot, and we in this industry, like I say, like to talk a lot about the speculative explorers, but I think it's important at this stage in the game, at this stage in the cycle, to position in some of the guys who produce gold. B2 has, unlike a lot of other companies on the producer end of the spectrum, they have spent this bear market developing new production. So they have this really low-cost mine in Namibia that is just getting underway. The cost structure there is phenomenal. Because of what they've how they've managed growth, they now have, and how they've acquired debt, they now have all the money that they need to develop their next asset, which is the Fekola project. Right now, they're already producing 500,000 ounces a year. Once they develop Fekola, they're going to be up almost at 1,000,000 ounces a year. So there's a really good pipeline of production that's coming on. Their hold on costs is really impressive, and they pay a dividend, and they're available at a very low cost. So I think it's one of those really good examples of what you can acquire right now.
Okay, thank you so much for joining me today, Gwen.
Thanks for having me.
I'm Teresa Matic with the Investing News Network.